More fallout from Trump's tariffs. Automaker Stellantis is temporarily halting production at some of its auto assembly plants.
Something cracked today. Not a headline, not a stock price, but a business model. For years, tariffs were a storm that hovered overhead. There were warnings, there were forecasts, there was noise. But today, 5 major companies issued the same verdict. We are not waiting anymore. We are leaving, not in protest, not in politics, in survival. As of May the 27th of the year, 2025, the cost of staying in the United States has surpassed the cost of leaving for some of the country's biggest brands. These companies are not shutting down entirely. They are not disappearing, but they are changing course, scaling back, routing, relocating, escaping the gravity of trade war economics that has turned America's biggest marketplace into a risk zone. The first of the 5 is Stellantis, the global automaker behind Chrysler, Jeep, Ram, and Dodge. This morning, Stellantis confirmed it would lay off over 900 workers and temporarily idle multiple production lines in both the United States and Mexico. With Trump announcing new tariffs this week, workers at carmaker Stellantis were worrying about their futures. The company announced Thursday it is temporarily laying off 900 workers at 5 U.S. plants. The company's statement was direct. The new 25% tariff on foreign-built vehicles has made its North American production model unsustainable. Nearly half of Stellantis vehicles sold in the U.S. are imported from overseas, with the base import tariff now 10% and certain categories hitting 25%. What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2 and 12% base, which is what we were at, and we go to 25%. The math no longer works. The company's America's president said Stellantis was taking immediate operational action. Translation, stop the bleeding. The United Auto Workers Union responded with fury, calling the layoffs a horrifying consequence of reckless tariff escalation. They warned that American workers are now paying the price for a global trade fight they never signed up for. It was not just a labor story, it was a manufacturing referendum. The factory is no longer sacred. The assembly line is no longer immune. Then came Apple, a giant among giants. For years, Apple avoided direct tariff exposure by balancing its Chinese production footprint against a shifting landscape. But now that strategy has reached its limit. Today, Bloomberg confirmed.
And Apple is all set to move the assembly of all iPhones sold in the United States to India by as early as next year.
For the second straight month, 3 million iPhones arrived from Indian plants last month. At the same time, iPhone exports from China to the US collapsed by over 75%. That is not a rebalancing, that is a migration, and it is one Apple saw coming. In early May, CEO Tim Cook said most iPhones sold in the US would eventually be made in India. Today, that transition is no longer eventual, it is underway. The reason is obvious. Trump's proposed 25% tariff on all iPhones made outside of the United States. Apple CEO Tim Cook's that iPhones sold in America should be manufactured domestically. If that is not the case, a tariff of at least 25% must be paid by Apple to the US. Apple responded not with a press release, but with logistics. Factories in Chennai now handle what Shenzhen used to. Assembly lines have moved. Supply chains have been rebuilt. The cost of staying in China and importing into the US has become too volatile. So Apple is walking. Next, the digital retail revolution took a hit. 2 of the fastest-growing e-commerce giants, Shein and Tu, announced major changes to their US operations. The reason, a devastating change in trade rules. The US government officially ended the DAME exemption for packages under $800. That policy allowed low-value goods shipped directly to American customers from China to avoid tariffs. Now, every package faces full duties up to 145%.
White House has clarified the tariffs on China as being at 145%. We can speak to Zhong Yuan Zhou Lui, who's the Morris. For companies like Shein and Temu, that was a business model built on speed and scale. They shipped directly from Chinese factories to American doorsteps, bypassing US warehouses and taxes. That loophole is now closed. Shein responded by warning customers that some product prices may rise, even as it tried to absorb costs internally. Temu shifted strategy entirely. It restructured logistics to focus only on products already stored in US warehouses, promising no import charges for those items. But behind the scenes, both companies have slashed US advertising budgets and paused new campaign launches. Smaller overseas brands have gone further. UK beauty brand Space & and Canadian lingerie startup Understance have stopped US shipments altogether. For now, Shein and Temu remain operational, but their US growth engines have stalled. The tariff wall has closed the path they used to dominate. In the consumer products sector, MGA Entertainment, best known for Bratz dolls and LOL surprise toys, announced it is moving nearly half of its production out of China. The California-based company is not waiting for the next tariff hike. It has already started relocating manufacturing to India, Vietnam, and Indonesia. According to a spokesperson, 40% of MGA's toy production will be relocated within the next 6 months. Why? Because China-made toys are now too expensive to import under Trump's tariffs. This is not a marginal move. MGA's toys line the shelves at Walmart, Target, and Amazon. They are mass-market staples, and now they will come from different countries if they come at all. For parents, that means some toys may become more expensive, others may become harder to find. For Walmart and Target, it means recalibrating entire inventory categories in time for the holiday season. For competitors, it is a signal. Tariff avoidance is no longer a theory, it is a necessity. And in the industrial sector, Alcoa, the American aluminum powerhouse, joined the list. Today, executives confirmed they would begin rerouting Canadian aluminum shipments away from the United States, sending them to Europe instead. Normally, Alcoa's Canadian smelters feed US demand, but new import taxes on Canadian metals have made that strategy unprofitable, so Alcoa is pivoting. More aluminum will now go to the European Union, where trade terms are more stable. At the same time, Alcoa said it may increase shipments from its Australian sites to serve US customers if those operations prove less tariffs sensitive. The company called it optimization, but what it really means is this. Canada to US supply is no longer the default. Alcoa, like others, is rewriting its map, and it is doing so to survive. 5 companies, 5 sectors, 5 shifts, and one root cause: tariffs. What was once seen as leverage has now become liability. These are not political statements. These are balance sheet decisions. Each move is grounded in costs, forecasts, and market access. Companies are not asking what the president meant. They are asking what the next round of tariffs will cost and where they can go to avoid them. In this climate, the most valuable commodity is stability, and that is what the US market no longer offers. The threat of sudden tariff escalation, unpredictable exemptions, and political volatility has made long-term planning nearly impossible. For consumers, the consequences are everywhere, but not always obvious. The phone costs more. The toy is out of stock. The delivery takes longer. The shelves look thinner. The aluminum frame of your new appliance is priced 10% higher. The SUV you wanted, delayed or imported with a markup. Behind every product is a tariff, and behind every tariff is a strategic decision. Some of these shifts are permanent. Others may be temporary, but all of them carry the same warning. American competitiveness is no longer assumed. Companies are not rooted by patriotism. They are fluid by necessity. And when trade policies turn punitive, they adapt, they leave, they recalculate. And what comes next? More pressure, more movement, more recalibration. Some companies will quietly follow the path laid out today. Others may issue more announcements. Factories will close, warehouses will reroute, retailers will adjust prices again, and all of it will be called optimization. But make no mistake, this is the beginning of a long goodbye. What we witness today is not the end. It is the start of something bigger. A new era where doing business in the United States means navigating a tariff minefield that changes week by week. A new equation where cost trumps loyalty. A new question asked behind every executive door: is it still worth it?